Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry weekly prep and analysis webinar. It is currently Sunday evening here, 8 p.m. Eastern, start of the new business month, November 3rd. Grab your snacks, grab your water. It may be a little bit of a longer webinar than usual, as we have a lot to cover from market timing of starting the new business month. Very data-driven week with multiple rate decisions in focus. US elections around the corner, so a little bit of a volatility psychology reminder. And of course, our normal prep webinar schedule. We're going to be starting out this webinar, jumping right into it with a quick recap of fundamental events and analysis from last week on the main trading pairs and asset classes that we analyze and trade day in and day out. Then we're going to do a scan of the weekly economic calendar, the fresh events we have coming up. Right after that, we're going to do a little bit of administrative work using the weekly economic calendar of setting up our capital hungry schedule for the week. General times for New York sessions, updates for Asian sessions through the week, and so forth. Then we'll jump into our main meat and potatoes, which is some market sentiment and intermarket correlations analysis, market conditions analysis, analysis technically and fundamentally on gold, GJ, GU, EURUSD, USDCAD, US30 and SPX, with translating all that information into some trade ideas to start this new week. So let's get right into it. Starting out with our recap of key events and price moves from last week. Last week was a very interesting, important week as we were approaching the end of the business month, where it's very common to get EOM rebalance of flow moves. It was also, we also had some important data last week with some US inflation figures regarding PCE pricing data and some US labor market data. We also had the Bank of Japan rate decision, which brought some volatility, and some reactive events from the UK, which brought some volatility. We will talk about all of that individually when we go through the pairs. Starting out with gold here, overall, we've been very bullish on gold, on markets pricing in rate cut bets and looser financial conditions to come from the majority of central bank policymakers, and specifically looking at the Federal Reserve. Global liquidity flow still remaining healthy, with the majority of market participant demand being in risk assets and asset classes such as gold that thrive in a potential lower rate environment. And we've also seen that policy lag effects are no longer lagging, and weakness in US labor market growth and other economic activity data. This has kept gold significantly bullish. To start out the week, we didn't really have any major fundamental events in play. We were retesting previous all-time highs here and noticing a technical accumulation being created. It didn't look like we were showing any major signs of a pullback or retracement from the previous all-time highs. This led us to extending bullish moves to new all-time highs being printed into the 2790s. US inflation data remained relatively lackluster and still kept rate cut bets active, while other important figures such as JOLTS job openings were significantly lower, still supporting some gold bullish upside. Where we got the increase of volatility was right towards the end of the month. What started off this gold sell-off was, of course, very healthy jobless claims during the New York session on Thursday, October 31st. Very healthy jobless claims was pointed to be the catalyst that also led to an increase of rebalance of flow moves, aka buyers liquidating positions on gold from new all-time highs right into the end of the business month. This bearish move went deeper into the 2730s before we bottomed out and still had weaker NFP data right on the Friday that kept gold at these prices around 2755s. Later on the Friday New York session, we had higher than expected manufacturing prices paid, which put a little bit of upside pressure on inflation, regarding the US manufacturing sector. This is what led to gold having this downside move and retesting these same lows, with this new week opening up with a gap and failing to break lower. Overall, gold is still maintaining bullish market structure from this low of last week, and even if we see deeper pullbacks to 2720s. Whenever we're seeing risk assets or asset classes such as gold enter secondary phase of market structure, the corrective waves can be quite large, meaning gold could easily dig into the deeper 2760s again before seeing another bearish sell-off move. Forecasting deeper into the week, the main catalyst and focus is going to be US services PMI and US Fed rate decision, FOMC. We're going to be talking about that as we get closer to it, and especially going over it when we check the economic calendar through this webinar. In terms of the recap on gold, overall just had more bullish moves. Buyers print new higher highs. Right at the end of the business month, EOM rebalance of flow moves and profit taking, which the volatility trigger was very healthy jobless claims. During that New York session, we even called some bearish moves from the 2775s down into the 2760s. But with the bearish price action still holding steady, and noticing that major asset classes were all showing these profit taking moves, we were not rushing to jump back into buys right away. We were adapting to continued bears until we showed any signs of a support being created. Right now, gold is still maintaining macro and higher time frame bullish structure, but we do have to keep an eye out for the start of the new business month price setups, FOMC rate decision, and US elections volatility around the corner. I still think into the US elections, we can see further profit taking moves on risk assets and asset classes such as gold. For example, we may even see if the Feds are a bit more neutral to hawkish toned, just doing an expected 25 basis point rate cut or not cutting rates further yet, even into price setups for that if we're not breaking 2730 lows right away, some upside moves to create a lower high, hawkish Feds and volatility going into US elections, giving us deeper bearish pullback phases to, on the minimum, even come retest into the 2670s and 2660s. We can see US equities are also still respecting bearish corrective structure against the higher time frame bullish trends. And these corrective waves on gold, with me just being on the 30-minute time frame right now, not even on a larger intraday time frame, these corrective waves can be quite large in terms of the timeline and overall pip change of movement. We haven't really seen gold do a larger correction since these price pullbacks in early 2024 around end of March and May. If we're starting to notice those signs of exhaustion, seeing a similar size pullback going into the 2660s and 2670s on the minimum would not be out of the ordinary at all. Something we would need to adapt to, understanding buyers potentially liquidating positions into US elections volatility. And if we have any neutral to hawkish sentiment from Feds doing the expected priced in rate cut, but not giving any forward guidance to future rate cuts. This can still lead to gold if we're not printing any new all-time highs, creating a lower high, having some short-term bullish moves, but entering a corrective wave formation, coming down to create a higher low around the 2660s and 2670s. GBPJPY. Overall, we've been riding the bullish bias on GJ. At the start of last week, we had GJ gap up, and it wasn't filling the gap for the first half of last week. What made sense to us, and a great prediction we had, was that on GJ specifically, the main fundamental catalyst and focus was the Bank of Japan rate decision. We anticipated that BOJ could keep rates steady, but have a slightly hawkish toned approach just to set up some prices into the end of the business month of October and right into the start of November. This also lined up very well where we had some individual British pound weakness due to two reasons. One being Bank of England representatives having some more dovish toned news statements and headlines, and another being UK's government releasing their budget, where it highlighted them doing some fiscal loosening financial conditions from a government perspective rather than a monetary perspective, which still holds the same impact of weakening the British pound currency. Originally, we were anticipating that Bank of Japan volatility and liquidity grabs could lead to GJ coming down into around the 196.2 to 196.5 before looking for more buys again. Bank of Japan volatility plus the dovish tone comments and the GBP weakening comments from the UK government led to a bit of an extended downside move. But this downside was still relatively short-lived as Japanese yen weakness took over, and we had fantastic buys called after we came right back above 196.2 and to end the week through our New York market analysis session. This week, we do have Bank of England rate decision in focus. We will need to be careful, whereas it's very early into the new business month. We have been very focused on riding GJ buys, but GJ may see some downside if Bank of England is following suit with some of their signals they were giving from last week. And as UK inflation has remained lower and pretty much right at the Bank of England's target, as we're still holding above this liquidity zone, we wanted to retest into the 200s. We could easily have Bank of England rate decision bring us right back down to 194s, even down into 190s, creating some more higher time frame bullish market structure here before we really look for buys again. We may be adapting to short-term GJ bears this week if we cannot print any new intraday highs, and Bank of England is more dovish toned, which I expect them to be. And that can potentially see GJ having a larger bearish corrective wave in this bullish structure of seeing some bearish moves from the 200s and 198s down, even coming into the flat 190s before we think about any buys again. Overall, in terms of a quick summary of the events that took place last week, we were riding GJ buys for the first half of the week. Into the Bank of Japan rate decision, we predicted we would see a bearish move down into the 196.2s that would act as price setups into the new business month and also a technical gap fill here. We were also looking for buys back above 196.2. GJ analysis ran very well, but we do potentially need to adapt this week where GBP bears may still be more dominant going into the Bank of England rate decision if they're more dovish toned. GBPUSD and EURUSD, which have been primarily following the movement in inverse correlation of the world reserve currency, which is the US dollar. Overall, we did a fantastic job on dollar, where in the first half of last week, as we held above this previous intraday high, we anticipated dollar could still see some upside short term until we retest our next liquidity zone of interest around 104.4s before potentially seeing some bearish retracements. I think that dollar overall this week is still going to be extending even lower here before potentially getting a neutral to hawkish toned approach from FOMC, which can lead to a bounce towards the end of the week as the major rate decisions are on Thursday this week. Anyways, overall, dollar did follow our analysis very well of rejecting the next liquidity zone of interest on the intraday timeframes around 104.4. We also had US labor market data remaining generally flat and even had a gap down to start out this week in terms of price setups into the new business month of November. Overall, what we were looking to play on GU and EURUSD was retesting lower demand zones and starting to look for buys. Now, we did have a bit of a break lower than our buy area. Our analysis in the second half of the week was expecting to see a double bottom at around 1.29, short-term bearish moves on the dovish Bank of England sentiments and on the loose fiscal policy set by the new UK government budget. We wanted to just see a double bottom at 2.9 but we extended a little bit lower due to those catalysts. It was still relatively short-lived as dollar weakness took over and we snapped back above our buy zone. Euro USD buys played out a lot smoother, where we didn't have any reactive events to bring individual euro weakness. On Euro USD, we were anticipating to see in the first half of last week retesting into our buy zone, an intraday zone around 1.076. Still holding above there, where on Euro USD, that double bottom took place perfectly. On GU, we faked out before seeing the secondary buys again. On Euro USD, the buys were also a lot smoother, where we had the technical double bottom, break and retest above the next zone, and continuation above the key level. We also got a gap up to start out this week, something we need to look out for as we go into the rate decisions in the second half of the week. Overall, early into this week, I still want to play some of the dollar weakness. I personally think dollar is going to be bearish right until the Fed rate decision, and then a neutral to hawkish toned approach, just doing a priced in rate cut and not having any rush to do any further rate cut signals to market participants. I think dollar is going to have some short term bears, even coming down into this previous liquidity zone of interest before we see buys on the dollar potentially into FOMC in the second half of the week. This means that on GBPUSD, I could easily still see GU potentially even coming up to these liquidity zones of interest to the left here before seeing better bearish moves. And on EURUSD, I could see us even still coming up to roughly the 1.095s, maybe even slightly higher before seeing bearish moves in the second half of the week, where I'm predicting dollar will be short-term bearish to start this week and then see some bulls into FOMC. USDCAD ran our analysis very well, where we understood, even though dollar was having some bearish retracements and short-term weakness, that the Canadian dollar was still far weaker than the US dollar. Canadian dollar being weak from a much more dovish tone Bank of Canada. Bank of Canada being very aggressive with rate cuts and signaling at more rate cuts to come and looser financial conditions. Plus, Canada's main revenue source and exporting of the commodity crude oil being very bearish, which leads to more bearish moves on the Canadian dollars by market participants. We anticipated that UCAD could still see the buys to retest this wick fill point and previous highs to the left here before potentially seeing some retracement, which we saw right at the end of the week. US30 and SPX, we anticipated that we could see secondary phase of market structure taking place. The reason for this being getting deeper into US elections volatility, having the volatility index showing a bit of a support, US30 creating the secondary phase of market structure, and of course, end of month rebounds of flow moves. We anticipated that we could easily retest into this 41,800 demand zone on US30 before seeing any buy moves. We called some pretty nice buys at the end of the week, but I do think US30 is going to see some more cat bounces into FOMC and then potentially see another bearish leg down that could easily be coming down into the 40,200 prices here. What we were starting to prepare and forecast a couple of weeks ago, going into the month of November, into US elections and the rate decisions coming up, I think is starting to take place. What I mean by that is, I think US30 is going to see some short-term buyer bounces to trap the bulls, have a neutral to hawkish toned FOMC, more volatility and uncertainty going into US elections, buyers profit taking from these all-time highs, and creating normal secondary phase of market structure. You have to understand, when we're looking at US30 here, when we're looking at gold, when you're looking at SPX, we're very zoomed into the intraday timeframes. These asset classes are extremely bullish, but getting corrections isn't out of the ordinary, right? Now, I doubt we're going to see a correction on US30 all the way down to 37K. That would be quite volatile. But honestly, wouldn't be anything crazy by it anyways. On the minimum, I can see us still coming down to 41,000. Even this liquidity zone across the board here around that 40,200 price point. We are potentially starting to see the pricing characteristics and also the fundamental catalyst to see a secondary phase of market structure. Very similar to this pullback wave and structure here. Very similar to this pullback wave and structure here. Very similar to what I think is starting to bubble up here. You can see the price formations are quite similar. It's usually profit-taking moves from new all-time highs, which were highs at that point, and you start to see that you do have short-term aggressive bounces, but they're called dead cat bounces that trap buyers as you overall have whales liquidating out of the market, aka buyers profit taking, short sellers taking advantage in the near term, and price being pushed down to more favorable lower prices, lower demand zones before you continue the macro trend. I think we're going to see that going into FOMC this week and US elections. We may see some short-term buys on gold, US30, and SPX to start the week, then start to see some bearish positioning going into the FOMC rate decision and deeper into the US election volatility period. Overall, last week, we started to notice US30, SPX entering that secondary phase of market structure, where on SPX now, very similar to these pullback phases as we were discussing on US30, whether it was from the new all-time highs that were printed here, new all-time highs that were printed here, new all-time highs that were printed here. Even if US30 wants to see extended downside into the 5450s, I honestly wouldn't be too surprised by it. We do have to watch key reaction points as we're making our way down. But right now, if we're holding below this accumulation point that we broke below, even if we get some short-term dead cat bounces in this area, if we're seeing VIX picking up some heat, majority of risk assets not and gold not printing any new all-time highs, starting to form some technical lower highs, SPX also break below the 5700s, then seeing a secondary phase of market structure, as we understand the markets move in waves, is not out of the ordinary. Something we want to start positioning ourselves for and adapting to. The reason why I'm saying we need to adapt to this and potentially be very ready for this is it's very easy when we're riding the greed and risk assets in gold on rate cut bets. It's very easy to get used to a sentiment and bias. What do I mean by that? Well, even just from 2023 onward and 2024 onward, more times than not, you would be taking winning trades versus losing trades if you're day trading and scalping SPX, US30, and gold if you're sticking to the buy side. Fundamental reasons being markets pricing in rate cut bets, the market psychology of 1% greed. These asset classes are designed to go up in value and increase wealth, right? Increase wealth disparity as well. But that's a topic for another webinar. And you still had healthy global liquidity flows, volatility index relatively flat, just highlighting no major fear-inducing events. Riding these bullish waves is fantastic. But where traders lose the most money is that they can't adapt to these shifts in market where for a period of weeks, if not months, you can have very aggressive corrective phases. They'll still be trying to grab every single dip and buy during this corrective phase. And then you end up burning months, weeks, years of progress because you start spiraling out of control and you're still married to that same bias. As much as we can follow the higher time frames, as much as we can follow the fundamental sentiment and narrative on the macro, which keeps us right more times than wrong, what's also very important to us as day traders and scalpers, even from swing trading positioning, is still adapting to the ever-changing market waves that are more times than not fundamentally induced and price induced, right? Price induced is usually from new all-time highs and profit-taking moves and change in flows that take place. fundamentally induced is if you have economic events that are still pushing back rate cut hopes, like increasing inflation data or healthy jobs data, or going into US elections volatility, or having some hawkish toned FOMCs and rate decisions, right? So I do think that on SPX, on US30 here, on gold here, as bullish as we have been, we do need to be very adaptive when gold in these asset classes enters vicious corrective waves. And the reason why I'm also saying this is that through the entirety of 2024, we've had minimal pullback phase. In the secondary portion of 2024, we've just been riding SPX buys, US30 buys, gold buys, Bitcoin buys, silver buys, pullback buy, retest key level buy, double bottom buy, breakout buy. All I'm trying to say is if on the minimum gold sees a corrective phase that lasts 2 weeks or 2 months and is coming back into the 2600s, if you still just try to buy every support, if you still just try to buy every retest of a demand zone, this is where retail traders lose the most money amidst a higher time frame bullish trend, not adapting to the market waves. Does that make sense to everybody? Everybody following along so far with that? Bit of a recap, fundamental refresher. Any questions about that? Right? And you guys know, I've been the first one to tell you every single week, every single month for the last year, guys, no, gold's still bullish. Gold's going to keep printing new all-time highs. Guys, stock market's still bullish. Don't fight the greed train. Guys, US30 still bullish. Don't fight the greed train. And yes, on the macro time frame, these asset classes are still very bullish. But I'm also going to be the first one to tell you guys, hey, yo, wait a second. Let's put our foot on the brakes here. Let's adjust our psychology and market perspective. We don't just want to continue marrying this bias where it does look like we have some different events lining up that can lead to secondary phase of market structure. All of these asset classes conveniently new all-time highs, right? All of these asset classes just wiped out a significant amount of upside in equal or more aggressive bearish price action, which was end of month rebalance of flow moves. Like you could see this bullish squeeze getting canceled out in equal fashion, not just a slow and steady pullback, a choppy pullback, but starting to see a shift in the price action. All of these asset classes can see price setups with bearish moves due to any hawkish tone by the FOMC and any uncertainty and doubt during elections volatility. Now, some of you may be saying, but if there's fear, uncertainty, and doubt during elections volatility, wouldn't gold be bullish? Yes, that's true. But what's also very common during high times of volatility is aggressive liquidity sweeps and price setups, no matter what the asset class is. What do I mean by that? Let me show you guys an example. When we had the pandemic take place in March 2020, this is what gold did first. This is when the pandemic took place, March 2020, when you had global government enforced lockdowns, huge volatility, uncertainty, and doubt. Gold at that time was at new highs on the intraday during that time period. I know it seems crazy, 1650s back then, just 4 years ago. Now we're into like the 2700s, right? But anyways, gold at that time, right into the prime fear, uncertainty, and doubt and volatility of the 2020 pandemic, US lockdowns, March 2020 here, first saw an excessive downside bearish move for consecutive days, sweeping liquidity and order flow, excess volatility where you're seeing profit taking moves on all asset classes as a whole due to the mass hysteria and panic, and then started to rally from lower prices being retested, still maintaining macro bullish structure. I think some neutral to hawkish toned FOMCs plus the US elections volatility can see something similar take place. I do not see it being as volatile or as impulsive as the 2020 pandemic, but I do see it being correlated in relation to the upside moves we've seen. Now, if we see at here the same type of scenario, gold not printing any new all-time highs, starting to create some intraday bearish market structure, now into the volatility, uncertainty, and doubt and liquidity sweeps, going into elections volatility or any hawkish toned FOMCs, seeing something like this would not be out of the ordinary, would it? All asset classes during extreme periods of volatility, especially when they're trending extremely bullish, see buyers hesitant and liquidate positions, protect themselves, hedge the market, take some liquidity off the asset class, hold some cash on the side, reinvest or retrade into the market from lower prices. Right? That even took place when Russia invaded Ukraine here, which was going into the end of 2021 and 2022. Everyone notices this huge surge in price. They don't notice that before you had an aggressive bearish move that canceled out months of bullish price action, retested a lower demand zone, whale set up better prices, then you take off into the Russia-Ukraine geopolitical tensions. Right? Even the banking sector failures. But right before the banking sector failures, you had this take place on gold. Then the banking sector failures lead to this impulsive move. Do you guys get what I'm saying here? You always see during periods of high volatility, right before it or during it, the whales set up prices. First, protect themselves by liquidating some positions out of the market, profit taking, letting late buyers hold the bag and get swept out of the market. Then you see lower demanded prices get retested. Then you see the fundamental catalyst leading to a continuation of the trend. This was right before banking sector failures, before SVB and Credit Suisse collapsed. Aggressive bearish pullback move. At that time was high prices. This was right before Russia invaded Ukraine. Then you aggressive profit taking moves, aggressive bearish moves down to lower demand zones. Then you took off. This was right before 2020 pandemic. From highs at that point, aggressive bearish moves, very volatile, impulsive in the short period, then you took off. I think we're going to see something very similar into US elections volatility. Dollar starts to pick up more strength. The Fed is neutral, hawkish toned, slight pushback on rate cut expectations, increase of volatility due to uncertainty and doubt regarding US elections and which way it will go. Investors, whales, market participants protecting themselves, buyers liquidating positions, short sellers taking advantage in the near term, sweep late buyers out of the market, sweep liquidity, retest lower demanded prices. Then you see some more buyers come back into the market. SPX. Then you see more buyers come into the market. US30. Then you see more buyers come into the market. Even Bitcoin probably going to do the same thing. Silver's probably going to do the same thing. It's magical, isn't it? When you understand price plus timing and the fundamental events, and you can also reference previous fundamental events, right? Now, as you gain more experience, as you gain more knowledge, all of this becomes information you can use in your personal database, which is the supercomputer in your head, right? I don't expect everyone to know exactly when the pandemic first came to play, or when exactly Russia-Ukraine was, or exactly when the banking sector failures were, or exactly when we had Middle Eastern tensions spike again. Even before the Middle Eastern tension spiked, Gold did this dip, then started to continue higher. That's going to come with experience. But what I do want you to understand is once you backtest these events, see the similarities in price, in setup, in order flow. That it's looking pretty similar with gold sitting at these all-time highs. Haven't seen a large corrective phase or pullback. Buyers will be able to liquidate positions from new record-breaking all-time highs. Liquidity sweeps with the fundamental catalyst being US elections volatility. Something that doesn't just happen every day or every month, happens every 4 years, right? Just like all of these events don't happen every single day or every single month. Anything that can bring excessive volatility usually sees these price sweat ups and sweeps first. One more time. Even though gold is a safe haven, even though it turns bullish in times of fear, uncertainty, or doubt, when there's excessive volatility, major uncertainty regarding global markets or US markets, every asset class sees some type of liquidity grab. Pandemic, Russia invading Ukraine, banking sector failures, Middle Eastern tensions starting to heat up again, US elections volatility. Be prepared in the coming days and weeks. But that's just the first portion of our webinar. Already yapping a bit too much. A recap of last week, a bit of a zoom out and refresher, a bit of preparation of backtesting some various other scenarios, secondary phase of market structure on these asset classes. Now let's jump into our economic events calendar for this fresh week. Obviously, every single day, we're going to be doing market updates, New York sessions, and so forth. So I'm just going to be quickly scanning the main important events for the asset classes that we analyze and trade day in and day out. Okay. Starting out the week here, November 4th, sorry. November 4th, during our New York analysis session at 10 a.m. Eastern, we have factory orders expected to be relatively softer. This can still keep dollar a bit more bearish to start the first half of the week, give gold a bit of a bounce. I think dollar's going to be a bit bearish to start the first half of the week. Gold, stock market are going to be a bit bullish, then start to see stronger bearish waves going into FOMC and deeper into the US elections volatility. End of this week, next week. November 5th, London session hours. We have composite and services PMI for the UK. Still expected to hold steady in expansionary ranges. This can still give GBP some short-term strength in the first half of the week. Then may see GBP bears in the second half of the week if we have a dovish toned Bank of England sentiment. November 5th, North American trading session. ISM non-manufacturing PMI. Non-manufacturing PMI looks at composite and services sector PMI. Expected to see some declines in that data. Overall, still in expansionary territory. If we want to see more dollar bears and gold bulls, it's going to have to come out below 53, which is a possibility. November 5th, Asian session hours, 7:30 p.m. Eastern. Same set of PMI figures, but for Japan. Still expected to be generally weak, keeping the Japanese yen bearish. But on GJ, the main focus point is going to be Bank of England rate decision, second half of the week. November 6th, same set of PMI data for Eurozone. Not expecting major change on Eurozone PMI, expecting it relatively flat. Still see some Euro USD buys in the first half of the week, potential sells into the FOMC and onward. Then November 7th is going to be the heavy action-packed day. November 7th, we have Bank of England rate decision at 7 a.m. Eastern, which they're looking to do another priced in expected 25 basis point cut and be more dovish toned. If they have dovish forward guidance plus the cut, can keep British pound weaker, which is something we need to adapt to on GBPJPY. At 8:30 a.m. Eastern that same day, jobless claims, which had a very strong rebounding optimistic report, now expected just to go back to normal neutral ranges around 220K to 230K, forecast being 223K. Then that same day, 2 p.m. Eastern, Fed rate decision. Also expected to do a 25 basis point cut, but the main focus points is going to be the Fed speech and forward guidance they give. I think Jay Powell still taking a slower and steadier approach to majority of policymakers and may still be neutral to hawkish toned, not really giving the market much clues of what's going to come next, and just having a copy and paste FOMC, which can lead to dollar turning bullish in the second half of the week, and the stock market and gold seeing some bearish profit taking moves. Then to end the week on Friday, we just have some CAD unemployment and some consumer sentiment reporting. So the main focus points this week are services PMI from all major countries, Bank of England rate decision, Federal Reserve rate decision. For our AUD pair traders, we do have the Reserve Bank of Australia rate decision early in the week, but I personally don't analyze or trade many AUD pairs. Now, for our capital hungry schedule, today is Sunday. Right now it's 8:40 p.m. Eastern. Today we're just going to have this webinar plus the weekly flow. The first half of the week is more than likely going to be pretty choppy and slow and steady. I think we're going to do our New York sessions, New York Zoom sessions from Tuesday to Friday. Because then we're going to cover the Bank of England rate decision, the US jobs report, the US PMI data, the US Fed rate decision. We're going to cover everything guaranteed, right? If we do a New York Zoom session Monday, I'm going to have very low expectations. It may be more of us just chilling, bantering, analyzing markets, but not really being too aggressive, not really risking too much if we call any trades, saving our energy, saving our capital for more of the event-filled second half of the week. So doing a New York session Monday is 50-50. I'm first going to assess how price is moving over the rest of the Asian session, London session, and pre-New York. And then we're more than likely going to do a New York session if we do it from NYSE onward, just because we have factory orders at 10. It may be more of a psychology training day, chill training day. But Tuesday to Friday, that's where we're going to come with a lot more focus, a lot more intensity, and way more ready to execute trades, playing the fundamentals, catalysts, and the volatility it will bring. Okay? We will also be doing one Asian session this week. I personally think the best day to do Asian session this week is on the Thursday. But the Thursday is going to be a very busy day. Thursday, we may have 3 webinars. Thursday may have 4 webinars. Thursday, we may have Thursday, we will have a webinar early for the Bank of England rate decision. That will be our New York session, running into New York Open and initial jobless claims data. That session will start around 6:45 a.m. Eastern. November 7th is Thursday, right, guys? Double check here. The Thursday, right? Yes. November 7th is a Thursday. So the Thursday, we're going to have multiple webinars that day. Really come with high energy and high focus that day. 6:45 a.m. Eastern is the start of our New York session that day. We're starting earlier because the Bank of England rate release is at 7, and I do think they're going to bring some GBP bears that we can play. But regardless, we're going to have some volatility we can play. Then we're going to run that session into the New York Open in initial jobless claims. We'll probably end that session right after the jobless claims data is released. Then on that same day, at 1:45 p.m. Eastern, we're going to start our FOMC Zoom. We're going to run that for about an hour and a half, 2 hours. Try to break down what the Feds are doing, analyze some trade ideas, call any live trades if setups are clear and volatility is clean, and also set up some plays that we can look for in the near future. Then on that same day, November 7th, we're going to have our routine market update webinar. But I also do think running an Asian session would be the most advantageous that day because that day should be having the most volatility. That should also continue into the following daily candle, into the following session because we got Bank of England and Fed rate decision that day. So it may be quite a busy day. It may be quite a tiring day for me, but I think if we're gonna do an Asian session this week, compared to all the other days, doing it on the Thursday Asian session would be the best. What do you guys think? We might start the week out slow. Monday, just take it easy. Tuesday, Wednesday, normal New York sessions, normal market updates, high focus, high intensity. Thursday might be a jam-packed day. I'm probably gonna, if we do all those webinars, I'm probably not gonna go to the gym. That's gonna be my gym rest day. And I'm gonna go to sleep the night before because we have an early New York stream. We have a FOMC stream. We have a normal market update, and we'll do an Asian session that day. And then Friday to end the week, as it's going to be pretty quiet, Friday is going to be just a chill Friday New York stream like we did last week. Right? London sessions are normal schedule unless Mooj has something else going on, or if he's sick or has an appointment or something, he'll let everyone know ahead of time. Now, I was going to present this understanding liquidity zones webinar this week, but I think I'm going to delay that one more week because I think we should focus on the markets this week of the price setups for the new business month, the multiple rate decisions, and the volatility we're going to get in the second half of the week. And the entries webinar, I have not even started yet. I'm probably going to do that next weekend. All right. So that is our schedule. Now, we've covered a recap of last week's key price moves and events, bit of a fundamental refresher, bit of forecasting of events to come and backtesting previous events, potentially starting to anticipate some secondary phase of market structure that can be taking place on gold, US30, SPX from these previous all-time highs, as we didn't break above just yet. Might see some aggressive bearish moves this week. Before we jump back into the bullish bias on these risk assets and asset classes such as gold, especially if we have the prediction of a hawkish toned Jerome Powell, who just does the priced in rate cut or no rate cut, copy and paste FOMC, nothing new brought to the table. And if we see that bearish price action taking place on these asset classes due to the uncertainty and doubt regarding US elections, which are just around the corner, right? So with that being said, going into the individual analysis on these pairs and asset classes, gold has opened up the new week with not much of a lower wick here. I also wouldn't even mind if it digs a bit higher, has some short-term bulls before we start to see the weekly candle turn bearish going into Tuesday, Wednesday, Thursday, and Friday. Now, right now, when we're looking at gold on the intraday timeframes, it's still maintaining buyers in control if we're holding above the 2730s. But I would even love to see a bit of a double top at the 50% correction point and previous all-time highs here before looking for more sells, or even retesting these accumulation lows that we broke before looking for more sells. Overall, I see some short-term bullish moves on gold before potentially seeing bearish legs down, driving on the minimum into the low 2700s here, and potentially even lower. I'm going to be looking for majority price setups like this on gold. And I know you guys might be saying, gee, we've been riding buys for months. We've had so many bullish fundamental factors. It's pretty risky and ballsy. You're starting to call these reversals or these profit-taking moves. But Even though I could be wrong, sometimes you got to put your balls on the line. And especially when it's making sense to you, forecasting the movement across all these asset classes that are moving quite similar into very specific fundamental events like US elections or FOMC. If I'm wrong, I apologize. Maybe we'll still just be riding trend this week. Gold will print new all-time highs. But this is where we learn. This is where you put your balls on the line ahead of time. This is where you grow through trial and error, right? Now, what does that mean here? Overall on gold, I see a couple of trade ideas. One, if we break above 2740s, pretty solid bullish scalps and day trades. On the minimum to retest 2760s before looking for further sells. If we break above 2760, don't think about another sell again till at least retesting 2780s. Also, if we were just to break below 2732s, I would also see just some continuation bearish moves, which on the minimum for these bearish moves, I'd anticipate we at least revisit this liquidity zone into the 2710s, 2715s. Obviously, watching that as a make or break area if we break any lower. So, shifting our bias on gold here after riding buys for consecutive months, potentially positioning into price setups for the new business month, FOMC and US elections volatility. Still a very advantageous and solid buy if we break above 2740s. This is like a 200 pip range to our first pullback sell area of interest, where we saw the rejections and bearish move here, which was also previous all-time highs here. Also a rough 50% correction of this bearish impulsive move. So we could easily still see these buys play out, which I wouldn't even mind at all. Better price setups. This is still a very strong range to play for scalping or day trading. But I'm going to potentially see if we can position any sells from these three price points of interest. GJ. GJ, we have to be careful where we may see some GBP bears this week. One from the reactive events of the UK government releasing their new budget plan, which is highlighting fiscal loosening and weakens the British pound. Two from a potential dovish tone sentiment from the Bank of England, where they were giving signals of that last week, and their inflation picture is still looking a lot better than most countries, where UK inflation is already at the 2% goal and maintaining there. Now, overall, the major areas of interest that I can see GJ driving down to before looking for any bullish moves is any double bottoms around the low 196s here. Or even after we break that, I wouldn't even look for buys until we dig back into the 190s. Digging back into the 190s is starting to create more of this higher time frame bullish channel here, which looks absolutely beautiful when you draw that out, doesn't it? Right? It looks like after having this extended rally, where if we're not shifting out of the bearish market structure that starts to form, which we're potentially starting to see here, that we could see this structure holding out even for price setups into the new month into the 190s before we think about buys again. Remember, as day traders and scalpers, even though we could have a main bias that we've been playing, like we've been riding these GJ bulls, and they've been very good to us, right? Pullback buys, continuation buys. When GJ enters secondary phase of market structure, which is very common on the end pairs, look at this move, for example. This is from a new intraday high at 193, went all the way back down to 183, is almost 1,000 pips. It also lasted where it went from the start of September all the way into mid-September. It lasted 2 trading weeks, right? So if we're getting some GBP weakness, Japanese yen holding a little bit of strength on the increasing uncertainty and doubt regarding US elections, or of course, some some price setups for the new business month of November, us going from 199 down to 190, 900 to 1,000 pips over last week and through this week would not be out of the ordinary at all. And something we need to look out for, in my opinion, positioning wise, which is just where I have this structure drawn out here, just set up by a subjective trend line. And it would line up very well with where we saw more buy orders accumulated here after the PM Shiba election volatility of going into that same area. Right now, sellers are still in control from this price. Why this price? Even though we called fantastic buys, last week we even called some buys during New York, but I predicted we would only see this downside move get corrected and probably not break higher. This is the price where we saw more sell orders accumulated. Low printed, more sell orders accumulated, verified by a new lower low being printed. GJ still holding below this price and potentially breaking lower, entering this wave formation, can potentially see bearish waves down into the 194s, 192s, and even right back into this liquidity zone of interest here, which is the retest of structure around 190s. Something we need to potentially prepare for this week, in my opinion. Now, I'm just going to draw out a subjective trend line highlighting bears are still in control below this price right here. Okay? With that being said, if GJ comes to retest, where we saw this slight accumulation and break lower, or breaks these current lows, I do see bearish moves on the minimum to at least retest these lows and potentially dig even lower. But at least to start out this week, I would be seeing if we can get a sell from 197.8. Sells would still be valid below 198.2. Sells below 196.8 would also be what I'm looking for here. Markets may also be pricing in the expectations of a dovish Bank of England right before the meeting or right into the meeting. We're starting to see a larger corrective wave taking place. Right? For example, look at this. When we were starting to show bears in a pullback phase here, more sell orders were accumulated from here, where we had a pullback phase, and then more sell orders being accumulated here, verified by new lows being printed. You can see you had a very aggressive bounce here into that same liquidity zone, new lows being printed, retest of previous lows, and just had very short-lived bounces that never really ended up phasing this structure here until we retested much lower demand zones, more favorable prices before buyers coming back into the market. I personally think GJ may see some price setups like that into the Bank of England rate decision and into price setups for the new business month of November, especially with the UK government's new tax plan from a fiscal point showing some loosening, Bank of England being more potential dovish toned as well. I would also love to see these pullback phases because we can retest much lower demand zones before we start continuing the macro trend. GBPUSD. Now, I think this gap fill is going to take place during potential Bank of England rate decision and the Fed rate decision. I think we're going to be retesting this low in the second half of the week. Right now, dollar showing a bit of weakness. We could easily come up, in my opinion, to either one of these two liquidity zones before we see more better bearish plays. just to highlight this one as it's slightly above the key level here. I would love to see some short-term bullish moves. If we're still holding above the gap fill price in these two key levels, I would love to see short-term bullish pullback moves to retest these areas of interest before looking for better sell plays, which lines up with seeing short-term bears for the first half of the week. Dollar doing a bit of a retracement of that larger bullish run is done through October, creating a higher low, buyers potentially rallying into a potential prediction of a hawkish, neutral to hawkish toned FOMC. Otherwise, if we gap fill and break lower, I would just see the sells at least back down to the same lows. Now, these would still be pretty advantageous buy plays from holding above the gap fill point in 296 and holding above 2985 to retest the better sell zones. If we start to push up here, don't just sell randomly. Wait for the sell points. That means either being patient, cash on the sidelines, sitting on your hands, or taking advantage of the buys up to there, which is still very solid scalping and day trading ranges to play. Euro USD, I see potential buyers still in control short term here. Where we could be retesting into roughly 1.096, 1.0985 key level before seeing better sell plays. If we're holding above the gap fill price, holding above this gray zone, I would see a similar idea of some bullish squeezes up to these two price points of interest before looking for any better sell plays. Otherwise, if we don't get the pullbacks first, if we just fill the gap and break lower than 1.084, continuation sells back to these same lows. USDCAD, I would see if we're holding below the gap fill price, holding below the current price, that we could see some downside right back into this liquidity zone of interest that we used for buys previously before potentially looking for some bullish bounces from there, as the downside on UCAD may be relatively short-lived with how disgustingly weak the Canadian economy and Canadian dollar is. I'm ashamed of it. I'm ashamed of it. US30. Now, don't mind this subjective trend line. Bears are still in control where price was accumulated and more sell orders were collected and these new lower lows were printed, which is roughly around this price here. If we break above 42,000, I would see short-term bullish moves, dead cat bounce up to around 42.5 and below 42,350 before setting up better bearish moves, potential into profit taking at the end of the week, deeper into elections volatility, and FOMC. SPX sellers are still very much in control. If we're holding below this accumulation break point, which is roughly from 5,800, potential of a pullback into there before creating a lower high and stronger bearish market structure that can form. I would see to start out this week that if we don't break into new lows immediately, buys from these prices to similar to US30 before jumping into continuation sells. Otherwise, break the low continuation sells. Now, a few things that we have to look out for, psychology reminders. If you're sitting at the charts or if you're having alerts going off into the double rate decision day on Thursday, or we start to see reactive events regarding US elections that spikes volatility, calm down. Do not let the market volatility seduce you. If you start to become lost into just price movement, aka you're just looking at candles dumping or candles flying, your mind is gonna rewind back into a Neanderthal state, back into a caveman state. This is where you see massive volatility and people start commenting on Twitter, commenting on social media. Oh my God, this is dumping. Oh my God, this is rocketing. Holy shit, this is booming. Holy shit, this is about to crash. It's a waste of time. You're entering an idiotic state. You're not thinking about how to take advantage of the volatility. You probably didn't prepare and plan ahead of time. Now you're just going to be sitting there in a stupid state. More than likely, what's going to follow after that is an emotional trading decision. Volatility is your friend if you have the knowledge, planning, and risk management to take advantage of. This means be more selective with your trade entries this week. Potentially cut down your risk a little bit. Where if you're going to take, like, for example, a trade setup, you might have one loss before the good trade takes place. SPX may do a pullback. You sell right at the key level. It digs a little bit higher, then snaps back. You take a loss first, then you take a great win that wins back the loss. But if you're risking too much or over leveraging, that first loss is going to hurt you more than it should. And you're going to make even stupid decisions after, like try to buy even more after. Try to buy the top of the move now. Start second guessing yourself. Start doubting. Start having emotions come into play. Decrease the quantity of trades you take. Be more selective with your entries. This doesn't mean be scared. This just means be in control of your decisions. Don't just let volatility induce emotions, which starts to lead into you pressing buttons and entering trades, and then all of a sudden an hour or two goes by and you're sitting there with your account minus 10%, minus 20%, crashed account, failed prop firm, and you go, what the fuck did I just do? Why the fuck did I just do that? Why did I just spiral out of control? Right? Volatility is extremely advantageous for the patient, the disciplined, the self-controlled, and the knowledgeable trader. It can help them get fantastic entries. It can help them catch larger moves. It can help them hold moves for a longer period of time. Right? So be patient this week. Keep that in mind. But anyways, everybody, I do not want to be yapping too long. I do not want to make the weekly prep webinar more than an hour. I think we covered all angles in terms of preparation for the week. From a weekly recap, fundamental refresher, bit of back testing, starting to anticipate a secondary phase of market structure on major asset classes, being way more adaptive this week, putting our balls on the line to potentially see some moves against the main bias we've been playing, our economic events calendar, individual analysis, and some psychology reminders. I am going to save and upload this. It'll be available on the website maybe in an hour max. And then I'm going to send the rest of the weekly flow, aka the economic events and the normal graphics through the weekly flow, the infographics, either late tonight, as I have some family members coming over shortly, or early Monday morning, as I'm expecting a slow start to the week, more of the action in the second half of the week. But I think we covered the main meat and potatoes with this webinar. I know it's long, but I don't know how services and mentors out there talk for 5 to 10 minutes about the market when there's so much going on. You have to cover different time frames, the fundamentals, price action, market conditions, timing of when events are coming out. Obviously, when you're just talking about looking for a pattern, it's going to take 2 minutes. But patterns and trading models are only accurate if the fundamentals and market conditions line up with it. Everything fails when fundamentals are conflicting and market conditions are shit. Everything's going to be tough then. And everything looks easy when you have a very strong trending market or one-sided fundamentals. Everything looks easy then. But if you're not prepared for it, most people, even when their model or pattern is playing out, if they're not ready for the fundamental event, if they're not ready for the volatility, they still make a lot of mistakes.